All right, well, welcome everybody. Thank you guys for taking some time to join us for some continued educational content. Today is a presentation that I absolutely love talking about because it talks about beginning the journey. Now, I guess let me start by introducing myself. Jason DeBono, been with NuView for 15 years, so I've served in a variety of capacities here, and my job really is to get out and help people understand how self-direction works. And so we're going to talk today about how to use self-direction as a tool, even if you're just beginning your journey. Now, one of the things that I've heard so many times over the years is, oh, I don't have enough money to self-direct, or I don't have enough money to be a real estate investor. And in some ways, maybe that's true, right? But it's not always true in many other cases, because depending on what you want to do, right, in the real estate market, you may not have enough money. So if you said, I want to go buy a $300,000 house and I've got $2,000, then you know what? That just simply doesn't work. But if you step back and say, I want to be in real estate and I'm willing to find the right types of investments that fit my $2,000 in the account today, then self-direction can be a fantastic tool for you. We're going to talk about some strategies today that you can actually deploy with smaller balances and still control real estate and still make investments into other types of alternative assets. So we're going to go through that today. This is near and dear to my heart because 15 years ago I had zero money in a retirement account, zero, and I had to start. And since then I've been able to accumulate a lot of money in my retirement plans by diligently saving, which is about a third of what we're going to talk about today, right? How do I effectively save? What's the most effective account to save into? And then secondly is putting those accounts to work. And it wasn't until not too long ago, where I had a little bit more buying power. I was always kind of the short stack at the table trying to figure out, how do I get this money to work? It seems like as my account grows, real estate grows, and I never seem to have enough. But what I learned early on, thanks to a lot of smart people around me, was that you don't have to have a lot of money to participate in investment opportunities. And so we're going to walk through that today. Again, we're going to talk a little bit about saving, right? Where do we put more money away? Because let's face it, if you're starting your retirement journey today, then saving is critically important to you. And it doesn't matter if you're starting because you're 18. It doesn't matter if you're starting because you're 30. It doesn't matter if you're starting because you're 100. What matters is that you're starting and you start getting that money accumulated. Then we're going to talk about how to take that money and put it to work. So as we go through this today, this is a live webinar, but we do encourage Q&A and interaction throughout it. Obviously, we have too many people on the call to unmute everybody and try to get to them that way. But I do have a mouse up here, and I can see on my screen here, you have a chat function, should be in kind of the middle of your screen on the bottom there. At any point, if you have any questions at all, just type those in. They'll show up for me here, and I'll gladly get those read aloud and get those addressed. So please make this as interactive as possible as we all continue to kind of navigate it through the web-based educational content, based on the environment we're all living in today. So without further ado, I'm going to go ahead and kind of get started. First thing that I want to make sure everyone knows is we are not attorneys, we're not CPAs, we're not tax professionals, right? We're not investment counselors or advisors. We are third-party custodians of your retirement account. We can help you understand how to navigate through the process, what the rules are, right, and things you need to be aware of, but how it works on your tax return or what the legalities are of your investment. Those types of items tend to be issues that you would want to address with those professionals. So we will tell you when we can help, and we will also tell you when you need to seek some other guidance. So please don't come to NuView expecting us to be able to give you investment advice, legal advice, tax advice, and be your custodian. That is not the role that we play here at NuView. And we don't hide behind that. In fact, we embrace it. We want people to understand what allows us to let you buy what you want in your account is the fact that we don't play any other roles. So all the decisions that are made inside a self-directed account are yours and yours alone. But again, we'll help as much as we can. We'll point you to the rules, the regulations. We'll walk you through the process. But at times you may need to go seek professional guidance. So who is NuView Trust and what do we do? Well, for those that don't know, who we are, or this may be your first exposure to self-directed IRAs and NuView. We've been in business since 2003. We've got a long legacy. We've got nearly 50 employees, and we're a third-party passive custodian. Third-party passive custodian. So that means that we can hold your retirement account. We can do all the IRS reporting, that is required. But we simply hold the assets at your discretion. So unlike Schwab or unlike TD or Fidelity, who serves in the custodial capacity but also provides you brokerage, right? They give you stocks and bonds and access to investments. NuView provides no access to any investments. We simply hold your account, do the record keeping reporting, IRS reporting, and let you choose from a much larger slate of investments. So we're going to walk through what that looks like, but just understand our role in this process, while it's very similar to a Charles Schwab or a Fidelity, right? We're here to hold your retirement account. We don't actually serve that same role, and it's why they don't do what we do, right? They're not passive custodians. They actively hold brokerage assets and provide the custody for that. We provide passive custody to all types of investments, right? We're going to talk a lot about real estate because it's kind of the easiest thing to help people understand, but real estate is only about a third of what our clients actually do, and we'll talk about that here in a future slide. We hold about $1.5 billion of assets. So obviously we've been around a long time, and lots of clients have so graciously entrusted us to provide them custody. So of that $1.5 billion, it is spread out into all different varieties of non-public investments or alternative investments. And again, we'll get a little into that here in just a bit. So obviously, if you're on today's webinar, I'm going to be presumptuous, right? I'm going to be presumptuous in that you're really just beginning that journey. Now, your age doesn't really matter, right? The fact is you're here because you don't have a sufficiently large IRA, and it could be for a variety of reasons, but at the end of the day, you're starting that account, or you're continuing to grow it. The thing that this chart is here to tell you is something you probably already know. Americans just simply don't save. And you have to buck that trend, or you will end up just like the average American at retirement, which is borderline impoverished, right? Because Social Security will not provide you a meaningful retirement, right? It will maybe ensure you have a roof over your head, but it's not going to provide you any sort of meaningful retirement. The bigger part of saving for retirement is on you. But if we take a look at these numbers, obviously, the younger you are, the less likely you are to save, right? So if you go down these numbers and figure out where you are, this is the percentage of people that have not saved at all. So rest assured, regardless of where you fall, there's lots of other people in the same camp. So while you may beat yourself up and say, gosh, I should have started sooner, at least you're starting, right? There's a large segment of the population that's not even starting this journey. So kudos to you for getting through that process. So we're going to talk about savings. Now, one of the things that I talk about in every presentation I do, and it's one of my favorite slides, because it illustrates exactly why you should be saving, but more importantly, the power of saving in tax-advantaged vehicles. So if you think about it, if I take money out of my wallet and say I've got $100 and I'm going to save it, right? I've got options. So the first thing that people think of is, I'm going to take that $100 and I'm going to go buy a stock, or I'm going to go buy gold, or I'm going to go buy whatever it is. And what they tend to step over is, that's not saving, that's investing. Saving says, I'm going to put it in a place that can be retrieved at a later point. So I've got to find the vehicle first. That's my savings. And then I got to determine where I'm driving that vehicle second, and that's really the investment side of things. But so many people overstep that, right? They say, oh, I've got $5,000 to save. I'm going to go buy $5,000 worth of stocks. That sounds great, but when the stocks go up, if I didn't put it in a tax-advantaged vehicle, I just used my cash, it's taxable to me. And that may not be the most efficient. And I'm going to prove the inefficiency of taxable income here in just a second. So when we look at the way that we make money, the way that it works very simply in the United States, right, albeit the tax code is insanely complex, but it's very simple. Whatever you make in a given year, not what you have, but what you make, so whether it be income or earnings, right, gets totaled up. There's some depreciation and discounts and credits and all these other things, but forget about all that for a second. and then I owe tax on that net number. And the tax percentage, right, is a marginal tax bracket, so it depends on where I fall as to how much tax I pay. So what I want to do is I want to illustrate a dollar doubling 20 times, right? So imagine that you have a dollar, right, and you're going to make whatever investment it is that allows it to double every year. Now, certainly that would be a fantastic investment, doubling on an annual basis, but we're going to assume that you have 20 periods to double it. So a dollar becomes $2, $2 becomes $4, $4 becomes $8, $8 becomes $16, $16, $32, $32, $64, $64, $128, $128, $256. You get the idea. As you go through that, it sounds like, we're growing that money, so a dollar turning into something. So what I want to ask you, and somewhat of a rhetoric question since I can't hear your answers, is I'd be curious, and you're welcome to type them in the Q&A if you want, right, which is, what do you think that money would grow to, $1 doubling over 20 years? And I'm going to ask it to you under two scenarios. We're going to start with the first scenario, which is you have a 25% tax bracket. So invest a dollar, $1 becomes $2. I have a dollar of profit, 25% tax on that dollar is a quarter. That gets paid. I now have $1.75, right? Because I had $2 less the quarter I paid in tax. That $1.75 doubles, becomes $3.50. I pay 25% tax, and what's remaining doubles, and you get the idea. So the first thing, and like I said, if you want to type this into the chat just to have some fun, go for it, right? But I will ask, what do you believe $1 doubling over 20 periods with a 25% tax rate at each doubling period will net you in terms of end result? So 1 becomes 2, right? And so on and so forth. So I'm going to take that number, right, and I'm going to show you what it looks like when you have to pay taxes. That number is $72,570. Now, at face value, if anyone ever told me that if I give them $1, right, they're going to double it for the next 20 years, and I'll end up with $72,000, what would you do? Right? I certainly wouldn't give them $1. I'd give them 1,000, right? I'd give them as much as I possibly could, because $1 turning into that, man, that would solve the retirement crisis overnight. So what happens is that looks very attractive. And most people stop there and they go, well, that's the way, man, $1 becomes 72. This is incredible. The world is great. But now I want to ask you the question, and again, if you want to throw it in the chat, I'll pull them up there just to have a little fun. If you took that same dollar and you made the same investment that doubled every year for the next 20 years, but this time, prior to putting the dollar into the investment, you put it into an IRA. Then the IRA made the same investment. And by doing so, you are now no longer subject to the 25% tax rate. So what does that mean? $1 actually becomes $2, which actually becomes $4, which becomes $8. So now I will ask, how much money do you think you'll have by just taking one cursory step? One. Same investment, same amount, same time period. How much more money will you have by doing it through an IRA? That number is significantly higher. That number is $1,048,000. So let me explain what I just said and how important this is in your wealth building future. If you take $1 and you keep it in your personal name and you invest it all the way up, right, doubling it every year, you'll end up with $78,000. But if you did the same thing in an IRA, same dollar, same investment, you'll end up with over $1 million. Now ask yourself, if I really want to build wealth, which person do I want to be? Taxable or non-taxable? Now understand, I'm painting a picture, obviously, how attractive this is, and it certainly is. It doesn't make this unattractive. Turning $1 into 72 grand is amazing, right? Everybody would be thrilled to do that. But if there's a better way, why don't we take advantage of the better way? I know I'd much rather have the $1 million than the 72,000, especially knowing that all I have to do is just put it into an IRA first. That's it. So when we talk about wealth building, and for those of you that have joined this webinar, you join because you're trying to build something, right? It may not be enough today to get you where you want to be, but if you continue to use that money and put it to work. So I would challenge you to say, what type of vehicle, right, should you be parking whatever amount of savings you can get tucked away? So how do you save in retirement accounts? Well, let's talk about the plan types. So one of the things that I want to share, and this comes up all the time, is people say, which account should I select? And the first thought is, if you're asking me that, you haven't given enough thought, right? And in the world we live in an information age, you need to give some thought to these. Do a little research and understanding. The second thing is, if you use the word account singular instead of accounts plural, you're not getting this either. Because you should be saying, how do I get as much money to as many of these accounts as possible? Because what if I started with $5 instead of $1, right? What if I started with $1,000 instead of $1? What if I started with $1 million instead of $1? Look at how much more quickly these numbers would grow. So the better saver you are, the better outcome you're going to end up with down here. So when we go back to these plan types, it isn't a one-size-fits-all, right? This is what type of plan is best for you. The first question you have to ask yourself is, do I want to pay the tax now or do I want to pay the tax later? So if I go back to this slide, right, if this is an IRA, I still have to pay tax on that money. The IRS actually gives me two choices on when to pay the tax. I can choose a pre-tax account, meaning they're going to give me a deduction to put it away, and then I pay the tax at the end. So I would owe tax on the $1 million and 48,000. So even if I was at a 25% tax rate, I would end up paying $250,000 in taxes, assuming I took it all as one lump sum, and I'd end up with $750,000, still 10 times better than $72,000. Right? Or I can choose a Roth IRA. A Roth IRA means that I pay the tax up front. So in this scenario, my upfront contribution was $1. So my tax rate would be based on $1. So even if I was in the 90% tax rate, which doesn't even exist, I would have paid 90 cents in tax, put my dollar away, doubled it for 20 years, and I'd have $1,048,000 100% tax-free. So when it comes to the first decision is, do I want to pay the tax now, Roth, or do I want to select the other types of accounts where I get a discount on my taxes today, but I ultimately got to pay the tax later? I'm not saying the Roth is the best account, but you should always start with trying to get into the Roth if it's feasible, because it gives you the best ability to grow the account tax-free, right? So the Roth and the traditional work the same way. One is just taxed at the beginning, which is the Roth. The traditional is taxed at the end. You can see the contribution limit there is $6,000 or $7,000 if you're over 50. A SEP IRA is awesome for those that are self-employed. If you are self-employed, your employer can actually create a plan for you and any other eligible employees, so you want to be careful whether or not you have employees. And that plan, that employer can contribute up to 25% of your eligible income, up to $57,000. So if you have $100,000 of eligible income and self-employment, right, let's just assume you got no employees, you can put up to 25% or $25,000 into that account on an annual basis. A simple IRA is for small businesses. If you work for or own a small business less than 100 employees, a simple IRA is basically an IRA equivalent of a 401k. It's just a little bit less costly and easier for small employers to implement. So I only would even consider looking into that plan if you have a small business and you're not ready for a 401k, but you want to do something that may make sense. The HSA, I love the HSA. It's one of my favorite plans because it's, number one, it's tied to high deductible health insurance. We don't sell insurance. That's up to you to go out and secure. But if you have high deductible health insurance, the IRS is giving you a tool via an HSA to save for your medical expenses. The beauty of an HSA is it's the only plan up here. It actually works like a Roth and a traditional. So I get a deduction on my taxes when I make the contribution, but then I get to take it out tax-free like a Roth if I use it for qualifying medical expenses. That plan is absolutely awesome. I cannot say enough great things. If you are on a high deductible health plan, absolutely make sure you're getting money into your HSA as quickly and efficiently as possible. That plan is incredible. If you are not covered under a high deductible health plan, the next open enrollment period, whether it be through the marketplace or whether it be through your own, corporate insurance, I would look at what the discount in premium is to move to a high deductible. And what you're trading is you're paying a higher premium, a lower premium, but you're out of pocket more as you go to the doctor. It's like self-insurance. So you're covering the big stuff, not the small stuff. So think of it like your car insurance, right? You could have a $50 deductible on your car insurance, but nobody does. Everybody's car insurance is a $500 deductible. We do that because it drives the premium down. And we know that if we get into, if we ding our door and it costs $180, we just pay it ourselves. Well, that's exactly what high deductible health insurance is saying. It's saying drive down, buy high deductible insurance to get the lowest possible premium, right? So maybe you save $100 or $200 a month, and then if you do go to the doctor and it costs $80, you just write your own check. You don't need insurance to cover that. But what it is there for is if something catastrophic happens. Those plans are awesome. Take a look at them, but more importantly, the HSA. The ESA, $2,000 contribution works kind of like a Roth. It's no tax benefit to put the money in, but it's tax-free coming out for qualifying educational expenses. This plan is awesome. I've got an 8-year-old. This is how we save for his future potential college or vocational school expenses. Unlike college prepay or 529s, the ESA is a little bit more flexible in paying for stuff well before you get to college. So, in theory, we could send them to private middle school and use the ESA to pay for that, right? So there's some opportunities it presents, but the contribution limit there is $2,000. For those that are self-employed without employees, so if you are on this call and you are self-employed without employees, you need to call our team immediately to talk about the solo 401k or the QRP. This is the fastest way to accelerate your contributions, meaning get as maximum amount into the account, and it also is the most flexible and versatile plan because it works like a 401k, so you have kind of more robust features, but you get to self-manage it all because you have no employees. Whereas here at NuView, we have employees. We don't self-manage our 401k. Here, in a solo 401k, you can actually self-manage it. Awesome, awesome plan. I'm not going to belabor it on today's call, but take a look at getting yourself into that. Again, call our team and walk through that because that plan is awesome. Here's the thing. You can have a series of these. So I will tell you, I personally have a 401k here at NuView, right? I have a traditional IRA, right? And that's something that I'm considering rolling over to a Roth, separate discussion, but I have a traditional IRA. I also have an HSA, right? And we have an ESA for our son. So I have all 4 of those accounts, and I'll tell you as we get through this how I invest them, because most of those, especially the ESA and HSA, while I've contributed to them over the years, they're still smaller balances, right? So I don't have enough to go buy a piece of real estate in whole, but there's lots of things I do and can do with that money, which we're going to share here in a bit. So what are the things that you have to be mindful of? Well, first of all, once you have a self-directed account, you have full investment discretion. So regardless of what type of account you select here, you've got full investment discretion. That means it's up to you to determine what to buy. The only rules that the IRS has around what you buy is really telling you what they don't want you to buy. Everything else is fair game. So they're really saying 2 things. The IRS says, IRA owner, you cannot buy life insurance or collectibles with that money. So if you want it to be tax advantaged, you can't go out and buy life insurance, collectibles, artworks, metals and gems, stamps and coins, rugs or antiques, alcoholic beverages, anything that falls under what they define as a collectible. So that's a no-no. Pretty simple, easy to follow. Rule number 2 says the IRS says if you want that tax advantage growth, If you want to make $1 million at the end of 20 years instead of $78,000, you have to also ensure that your investments are made at an arm's length, meaning you're, as the IRA owner, you're only selecting investments that are in the best interest of the plan. And the way that they ensure that is by saying it's not really in the best interest of the plan if your investments involve yourself, your spouse, your parents and grandparents, children and grandchildren, or any of the businesses owned by those parties. And their idea here, or logic, is if I could take that IRA money in a tax-advantaged way and loan it to my business, man, I could do a lot of stuff that would skirt the rules or skirt the taxation. So they simply say, rather than trying to police it, you just simply can't do it. Today is not the time for us to make you an expert on self-direction, right? We have a team that you can call and walk through this process with, and we can talk you through it. But just note that if you're going to use a retirement account to go buy investments, you cannot buy life insurance or collectibles, and you cannot buy investments or sell or interact or transact with people that the IRS considers disqualified. Again, you, your spouse, your parents and grandparents, children and grandchildren, spouses of all those parties, as well as businesses owned or operated by any of those parties. So what do our clients do? What do people use their retirement accounts at NuView to do? Well, here's the most common things we see. Real estate, private stock, partnerships, debentures, LLCs, precious metals, mortgages and notes. Okay? We'll talk about lots of other things, right, that people do, but those are the most common things we see our clients do. I'm going to pause here and kind of see if we've got any comments or questions that have come in. If you do have them, now's a good time to get those asked. And gosh, and I'm sorry guys, I didn't open these before, but I had a couple people that correctly guessed, and they said over $1 million and in the millions. And you're absolutely right, pertaining back to that, how much would $1 double to if we didn't have to pay tax? Again, if you have questions, please type those in and give them to me. If you have scenarios that you're considering or wondering how this would apply inside a self-directed account, let me know as well. I'm happy to answer that. But you can see the list of what our clients do is infinite. Remember, if the only thing you can't do is life insurance and collectibles, the number of asset classes really is endless. This just kind of fits into what the most common things our clients are doing. So, let's get back on the screen here. So one of the things that I want to talk about has to do with figuring out where to invest dollars. And it's always a struggle, right? Because one of the things that people think when you have more money, the decisions either get easier or harder. And the reality is the process is the same. Investments are always tricky, right? Because you got risk and reward, right? How much are you willing to lose and how much could you potentially gain? That doesn't get easier with more money, and it actually isn't any harder with less money, right? The rules are still the same. If I've got $5,000 in savings, that $5,000 means as much to me as maybe $1 million means to another person, right? It's all relative, but the fundamental rules of investing are risk and reward. And what you have to decide as an investor, right, is where's your threshold for risk and reward. There are some people that take huge risks, right? And then there are some people that are very conservative. There's no right or wrong answer to that. That's the personal choice that you have to decide. What we talk about is the ability to buy what you want. And what I love about my job and what I love about what I get to do every day is I get to help people understand how to invest all different ways, but then at the end of it, they get to make the investment. They get to determine what's good for them. They get to do their due diligence. They get to determine, whether or not this fits their risk profile. And they get to celebrate success, and they also have the agony of defeat if they lose money, right? But the beauty is we as a company get to put the power of investing into clients' hands. The reason that this slide is so important is because you're seeing it play out today, right? If you go back to the middle of March, which if you look at follow the stock market, right, was right when really all the COVID stuff was starting to really hit the news. There was a lot of stuff coming out about, closing stuff down, and the market nosedived, right? 30%, 30-something% straight down in a couple of days. A lot of people thought stocks were on sale. Now, it's gone back up, so maybe they were technically on sale. But here's why I don't view that as being on sale, and here's why I also don't understand how the market works. So when we talk about investing, we talk about investing in what you know and understand, and it's really hard to know and understand what the market's going to do, the stock market, from one day to the next. It's nearly impossible, right? 20 million people go on unemployment and overnight. I mean, it's never happened before, yet the market goes up. There's no rhyme or reason to it, but what I want everyone to understand is that there's no such thing as a discount in the market. Even though prices were depressed and maybe that was attractive, you didn't buy it on sale because the price was the same for everybody, right? That's market value. When we talk about buying investments on sale, we actually talk about buying them lower than what the person next to you would pay. And I'll give an example of that. Real estate. If somebody puts a piece of real estate on the market for $200,000, I could pay $120 and the person next to me could pay $140. It just depends on why and how and what as it relates to the negotiation with that seller. So when people think like, well, real estate isn't really bought at a discount, well, of course it is. That's exactly how real estate is bought. In fact, it's one of the only asset classes that is always sold under an umbrella or premise of market value, which is appraisal, but it's not actually sold at that. I could go buy a property for 50 grand that appraises for 80. That is an absolute discount. And everyone else behind me may be willing to pay 80, but I may be able to secure it for 50. And so we talk about real estate and all these other investments, they give us the ability to buy this stuff at a discount. I can individually negotiate my piece of real estate. I can individually negotiate bid on my tax lien. I can individually negotiate on a non-performing note or on a structured settlement, right, or in a private company. I can do that with a self-directed account. In the stock market, I got to buy what everyone else, what everyone else is paying. And the problem with that is, even though they tell you not to time the market, right, never try to time the market, what do you do then? You never time it? You just buy stuff and hold it forever? Well, that doesn't seem like investing either. If that were the case, why do I need a stockbroker? Why do I need a financial advisor? If all I've got to do is buy and hold forever, that scheme doesn't work. You have to move and adjust and adapt with the times, and you have to be present to do that. And whether that's stocks and bonds or whether that's real estate, what you bought 10 years ago as a stock, i.e. JCPenney and Macy's, don't work today. If you bought real estate in an area, right, 20 years ago that was booming and was going crazy, and the huge plant that was there has departed, right, i.e. Detroit, you may not want to buy there any longer. Investing is about staying up to date, it's about understanding markets, and it's about capitalizing on opportunity. And it's really hard to do that in the stock market because no one really knows. And the fundamental thought of how things would go up and go down is always a challenge. So let's talk about some of the things that you can do, right, inside these new IRA accounts or these small balance accounts. So I used the example earlier, if you have a $200,000 house and you only got $3,000 in your account, $3,000 doesn't buy $200,000, right? Absolutely true. However, real estate options exist, just like stock options. A real estate option allows you to secure a property for a pre-agreed upon price for a pre-agreed upon amount of time. So I may come across somebody that's selling their home and that needs to sell their home. Could be a divorce, could be a variety of things. And they may really need to sell it. And so I may be able to help them, right? Hey, listen, you can go get a realtor, and that realtor is going to charge you 6% when it's all said and done, right? 3 on the buy side, 3 on the sell side. You're going to go through this process, etc. What if I said to you, I'll give you $3,000 today, and I will guarantee to buy your property for $200,000 over the next 90 days or 120 or 12 months. Well, gosh, I don't have to go through anything. You're going to go take care of all the labor work? You bet. And then I turn around, and now I got to go sell that property, right? Now, obviously, I wouldn't put an option on a $200,000 property if it was only worth $200,000. But I may put an option in at 150 or 180 because they just need quick money. And I can offer them the ability to close quickly. And then I can turn to the marketplace and I can go find buyers, right? And the better deal I got on the property option, the better opportunity I'm going to have to sell it down the road. So options are amazing because you can put very little money. I mean, I've seen people do options with $10, right? But what they've done is they found the right type of people that are willing to make a deal on a property to get it sold. And some people would say, well, that seems crazy. Just go through the real estate process. A lot of people don't want to hire a realtor. They don't want a bunch of people. They just want someone to get rid of this asset. And so we see this a lot in divorce. We see this a lot in probate. We see it a lot in inheritance. People end up with a property that they just don't want. And so it's easier sometimes to rip the Band-Aid off and get rid of it than it is to try to squeeze an extra 10 grand out of it. But for me, I can give them $100 as an option and go sell it for an extra 8 grand, and I come out way ahead because I just turned $100 into $8,000, right? I certainly doubled that dollar. So for the sake of 8 grand, they come out ahead, I come out ahead, and the buyer ends up with the property. It's a win-win for everybody. Real estate options are absolutely something that a lot of people do. They're not necessarily, everybody isn't going to sell you an option overnight. You got to understand it. But if this is intriguing to you, then I'd go out there and I'd find some smart people in this world and get educated. Raw land. So this is a strategy that I've seen a lot of people deploy with smaller balances. So raw land comes in a variety of formats, right? You can buy single-family home sites, you can buy, big tracts of land, and you can buy anywhere. And you may be surprised at how cheap some of this stuff is. Depending on where you reside, I guarantee you, within an hour of you, there's a place that 20 years ago, if you had 50 grand, you'd have bought up a ton of land. And you'd have bought up the cheap land out in the middle of nowhere that automatically became something. And it's just the way, the path of progress. There's so many areas in every town whereby the path of progress gets a little further out and a little further out. And there are areas that, man, 20 years ago, that was cow patties. You could buy that stuff for $1,000 an acre, and now it's selling for $50,000 an acre. That happens all the time. So we see a lot of people do that. Another strategy that I've seen is what I think is actually brilliant is there's a lot of people that will go find, parcels of land through tax lien or tax auctions, and they're not great properties, but what they do is look for them next to someone that has a house on it, and they try to sell it to that homeowner. So if I can go secure a small piece, really tough to build on piece of real estate, right, for really cheap, then I can reach out to the homeowner. Hey, Mr. and Mrs. Smith, you own this property. Did you know this property next to you is for sale? Did you know that I'm willing to sell it to you for $25 a month, right? Man, now that's really attractive. So for $25 a month, I can actually have this property, right? I can expand my footprint of the real estate that I occupy. Well, that's really cool. And I don't mind financing it over a long term because if I didn't pay much for it, I can actually make return on the financing side as well. So I can take maybe a $2,000 lot I bought, sell it to them for $5,000, right, which is 2.5 times my money, and then factor out their payments as if they were paying a 5% interest. So I'm getting 5% on the $5 grand plus 2.5 times my money when it's all said and done. Cool strategy. There's lots of those, and you don't have to have a lot of money for that. Contract for deed is something a lot of people, I shouldn't say a lot, we see a lot of people do with raw land. It allows you to hold the deed much like a car payment, right? You don't actually get the title to your car until you pay it off. Contract for deed can work the same way, right? Understand the laws in the particular state that you occupy, but there's lots of real estate that people are buying, and there's lots of raw land that can be very, very inexpensive that maybe 5 or 7 years down the road will be very, very valuable real estate. So if you have those opportunities in an IRA, don't be scared to hold a property for 10 years till it becomes something. If you believe that it's slowly going to go up in value, yeah, you may have a small tax bill on it, but if it can become that next area or path of progress, especially if you continue to see expansion in the city or town that you reside in. Tax liens. This is an interesting asset class because this is an asset class that has always been popular. And it's very popular amongst large hedge funds and corporations that they invest the millions of dollars into tax liens. In fact, I didn't know what a tax lien was when I was in college. I didn't understand it, but I worked at Macy's. There was a guy that I worked with, and he took a job with this company, and his job was to go to these tax auctions before they moved online and just buy everything that they told him to buy. So he was just the local guy in the market, and they'd say, okay, you've got $1 million, you need to spend it on these 100 properties. And he'd go there and $2,000 tax lien, and he'd bid it, and they'd give him the window of interest that they wanted to earn. And their view was, if we bought enough properties at an average rate of 8%, let's just say, and maybe 10% aren't successful and it drops our rate down to 7% return is still a very good return. And for a lot of these big hedge funds and corporate, these are hedges, right? These are non-correlating ways to make money so that if other things go down, maybe this goes up. What's cool about tax liens is it's this. You are buying the unpaid taxes on someone else's property. You're not buying the property. You're buying the unpaid taxes. So if you think about it, every municipality has a budget. The largest item of their budget tends to be property taxes. Well, if I believe, and I run, Orlando, and I believe I'm going to have $100 million of property taxes, I need that $100 million. I can't be in the business of only getting $90 million and then being $10 million short, because I've already predetermined I'm going to go spend that money. So what they do is they say, if any homeowners don't pay their taxes, we need the money, so we're just going to go sell their tax liens at an auction. We're going to let people buy their tax lien. So somebody doesn't pay $2,000 tax bill, I come in, and the bidding starts at 18%. And the beauty is the state or the county doesn't care what you win it at, because they're getting their money out and being made whole. You are then entitled to that level of interest from the homeowner when they finally pay. So if I go out there and I bid, it starts at 18% and works down, and I buy your tax lien at 12%, I have a lien on your property that can't be satisfied until I get the amount I paid for the tax lien plus my 12%. This is so cool, right? So as long as that property eventually will change hands or has a reason to be paid, I'm going to get my money and that interest out. So the thing about tax liens is they could pay off tomorrow. Right? Somebody could realize, oops, I didn't pay my tax bill, I forgot, I'm 2 months behind, and they could go pay. You may only get a little bit of interest. Or it could be the opposite, which is they never pay. And then you need to you want to make sure that your lien is on a good quality property, right? You don't want to buy a lien on an easement or on something that has a bunch of other liens that may supersede yours. This isn't as easy as showing up at the county and bidding, but this is a phenomenal opportunity to go buy, and you can buy a $1,000 tax lien. So if you don't have a large IRA, if you bought a $1,000 tax lien at 12%, that can be a great investment. So tax liens are something that we see a lot of clients do. Let's see. Let's pause for a second here. Let's see what we got from the Q&A standpoint. All right. A question says, under your choices, are mutual funds okay? The short answer to that is yes. Our clients, we have an institutional relationship with TD Ameritrade. So if you want to trade something that's brokerage related, stock sponsor mutual funds, we are not a clearing firm. So we will hold your IRA. You will direct us to take whatever amount of money you want to put into mutual funds, and we'll move that into a trading account at TD Ameritrade. So you'll authorize us to do that, and then you'll make your trades directly through TD. But it shows up on your statement underneath your brokerage account at the NuView level. So yes, you can do it, but we use TD for that. We are looking to possibly clear those ourselves in the shorter term future, but that's not something readily available today. Another question that says, can I partner with my wife's IRA contributing cash towards a real estate purchase? If so, I put up to 20% cash. May we use the property 20% of the year for personal use? Great question. I'll get to that in just a minute when we get to partnering, right? I absolutely will get to that. Let's see, we've got something that looks like it may have come through here. It says, I would like to start investing in real estate and want to start an LLC for asset protection. Will a self-directed IRA be the best way to start investing? So it depends. It really depends. So as far as wanting an LLC for asset protection, so any investments that we talk about, you could absolutely do through an LLC inside your IRA. So the IRA is set up through NuView, and then you would set up an LLC for that IRA to invest into the LLC, and then the LLC would go buy the tax liens buy the real estate. So you can use an LLC structure inside an IRA. That's up to you. If you go to the blog section of NuViewTrust.com, there's some things in there. It's referred to as a checkbook control IRA, and you can go take a look at that past video if you want to get up to speed on that, or call our team. We can walk you through that. As far as the idea of is that the best way to do it, well, it depends. If you do it through an IRA, you're doing two things. Number one, you're eliminating your tax liability on an annual basis. Remember that slide of doubling a dollar. The second thing that you're doing is committing not to take that money out till later. So what trips some people up is they want to save, they want the tax advantages, but they want to earn the earnings today. If your goal is to invest to pay your mortgage or to invest to pay your personal bills as a way of life, then an IRA can't fix that problem for you. What we talk about is a passive approach to still saving, still investing, but you're not investing to make a buck today, you're investing to build wealth for the future. Because one of the drawbacks to an IRA is that it won't pay your mortgage today as a general rule. It's designed, right, to be a long-term vehicle. So to answer your question, if your goal is transitioning to real estate as an investor to pay your bills and really use it as a career, this isn't the IRA won't help you. If your goal is to build some long-term wealth and use real estate as a strategy within the most tax-advantaged vehicle, then man, the IRA is you're not going to find anything better than the IRA for that, all right? Personal loans. So just so everybody knows, this is what I've done in my own retirement account. Now, this is how I've built my retirement plans. Remember, I have an IRA, I have an HSA, I have an ESA, and I have a 401k. I've invested all of those into loans. And I'm going to talk about how I invested them all into the same loan, right? But loans have always been a strategy that I've deployed because they tend to be pretty straightforward. What's cool about loans, and especially personal loans, now you have to be careful because you want to make sure you're going to get your money out, right? As Warren Buffett says, return of your principal is better than return on principal, and that's very true. So when we look at some of these things that we've seen clients do, maybe you know someone, maybe a good friend of yours, has unfortunately piled up some debt. They got a good job, right? They got a stable job. They're good with their money, but maybe they made some choices in the past. The average credit card APR is 17%. So you're sitting here saying 17%, that seems outrageous. Well, what if you could come in and say, hey, Billy, Sally, we've been great friends. You've shared enough to know that you're trying to get your credit cards paid off. What if I could help? What if my IRA loaned you 10 grand, right? And you paid those off, and instead of paying 17%, I'll charge you 10. They win and you win. Now, you want to make sure you're going to get paid. So if you're not going to have any collateral, then you want to vet it really hard, right? But if you believe that they're absolutely making their payments, they're going to pay, right? Why not step in as an opportunity? I'll tell you a deal I'm evaluating right now as we speak. I've got a good friend that he's a barber, right? And he's got a barber shop and everything, but he's self-employed. He wants to buy a boat. He's having the hardest time getting finance for a boat because he is self-employed and they don't like the idea of loaning money on some sort of, personal item like a boat, right? So he's having trouble getting finance and they're trying to charge him exorbitant interest rate to get this deal closed. He's got plenty of money to put down, right? Plenty of money. So he was telling me the story and I said, what if I stepped in and financed it? I want enough money down to feel comfortable. I can have the boat as collateral, so in the event that you don't pay, the boat is mine. But instead of paying a 9% interest rate through some, the only way they're willing to get you financed, what if I charged you 6? What if I charged you 7? So there's ways where you can hear these stories and use your own retirement account to step in, right? And to me, man, what better way knowing that I'm getting a big down payment so there's plenty of collateral, even if it is a depreciating asset, and I still have a personal guarantee, meaning in the event that he defaults and the boat doesn't cover the debt, I can go after his personal assets, right? There's a lot of value there. So use that as an opportunity, right? Because it's a win-win situation for everybody. He was elated when I told him I would do that at 6 or 7% interest. Elated, right? I can't go get that in cash anywhere else. So to me, those are opportunities that present themselves, and I'd be willing to bet most of you have those opportunities potentially presented to you in your own life. You just need to be looking for them, and that's a great opportunity with smaller balances to put it to work. Partnering. So there was a question that was asked, can I partner with my wife? I'm going to just take this back and answer it at 40,000 feet, and then we'll drill down to ground level. So first of all, partnering is how I've done about 90% of the transactions I've done in my retirement accounts have all been partnering in some way, shape, or form. Partnering simply says I do the deal with other parties. Sometimes those other parties are completely independent third parties. Sometimes the parties are my 401k, my HSA, my son's ESA, right? I can put those together and go do a deal. When we mentioned the rules earlier, I mentioned that your IRA cannot do business with you, your spouse, your parents, your grandparents, children and grandchildren, spouses of those parties and businesses of those parties. But what I didn't tell you is that partnering is not doing business with, and I'll illustrate that. If I am prohibited from doing business with my wife, right? Because the IRS says if I'm changing money between my IRA and my wife, I could easily be using it to manipulate the taxes. Too much risk, from an IRS standpoint, and it makes sense. But could my IRA go out and buy shares of Microsoft today? Of course. Could my wife both personally and or in her IRA go buy shares of Microsoft tomorrow? Of course. My shares are titled to me, my wife's shares are titled to my wife. If Microsoft goes up, I make money based on what I own and she makes money based on what she owns. Completely independent, but we own the same asset. The beauty is you can do that in the real estate or lending market as well. So if I want to write a loan for $50,000 and I have 30 in my 401k and 10 in my HSA and 10 in my ESA, I can't do that without all three. So I could do part of the loan and find someone else, or I could say, sure, I'll do the $50,000 loan. I'll write $30,000 of the loan for my 401k, $10,000 of the loan for my HSA, and $10,000 of the loan for my son's ESA. That will provide me a prorated interest, right? I believe it's 60-20-20. So 60% of the loan is owned in my 401k, 20% in the ESA, and 20% in the HSA. That means that 60-20-20 is how I had to buy it, and 60-20-20 is how I collect all the income. If there were expenses, I'd have to pay them 60-20-20. The reason that's allowed is because I've not actually changed hands. Money's not changed hands between me and my IRA, or it's not changed hands between my IRA and my son's ESA. It simply allowed us to all buy the same asset, clearly titled to each asset, and each account is responsible to stand on its own 2 feet. So going back to the question, can my wife, or can me and my wife's IRAs, non-IRAs partner to buy a piece of real estate? Yes. However much money each party brings to the table is how much money they own, or what percentage they own. You cannot change it later. It's carved in stone. Your question that was asked takes it a step further and says, if we use our personal money for 20% of the property, can we get 20% of the use of the property? And unfortunately, the answer to that is no. So if my IRA buys 80% of a property and my wife and I personally buy 20%, we cannot use 20% of the property. Not in terms of 20% where we only walk in part of the kitchen or part of the bathroom, nor in 20% in the amount of time in a year. If your IRA owns any part of the property, you can never use it, right? It has to be strictly a passive investment. And the reason for that is what they don't want is people buying vacation homes and other things through their retirement account. So I understand the logic that if you've got a personal interest, you should be able to execute on that, but the IRS simply says no. What partnering does is it simply says my IRA can partner with anyone so long as we never change hands between disqualified parties and buy whatever investments we want, so long as their pro rata ownership is based on how much money we put in and we collect and pay income and expenses in the same pro rata ownership. So I'm going to pause there because I'm assuming that probably has created some questions, but let's take a look. All right, I haven't seen any new ones coming in, so if you do have them, ask them. We've got about 5 minutes left, and we're going to wrap up. So now would be the time to kind of get those questions asked. So if you have a small balance IRA, find people that have big balances. That's exactly what I did. The very first deal I ever did, I owned 4.5% of a private note. That was it. The rest of it was owned by other parties. So there's plenty of opportunity there for you to do it. You just have to find the parties, right? And it could be family members. It could be good friends, right? It could be other accounts you may have. But don't be scared to find other people to help you get that deal over the finish line. And remember, if you put money into a deal and the deal generates 20%, you didn't make less money because you only own 10%. You still made 20%, just in a smaller dollar amount. But I partnered loan after loan, and then when I started my HSA, I brought my HSA in. When my son's ESA started, we brought that in. And so we've always made loans. And now I'm to the point where between the accounts, I can go do loans myself. And sometimes I'll do a loan with just my 401k, and sometimes I'll do the loan with my 401k and the ESA, depending on where the money is and what the investment opportunity looks like, right? But that's how the journey works. You can't think about what you're going to do 10 years down the road until you figure out what you're going to do today that's going to get you where you want to be 10 years down the road. So 15 years ago, I didn't have a single dollar in my retirement account, and now I've built it up to where if people call me to do a full-blown loan, I could do it. And you can put yourself in that same position. Partnering can be a great strategy because it allows you to leverage a small balance alongside maybe even people, for me, like the reason I partnered with them is they were way smarter. They helped me vet the deals and all of that, and you can go participate. So just something to be thinking about. Partnering can be a very, very attractive option. All right, so I'm going to pause here as we go down the home stretch. I've seen a bunch of questions pop in here, so let's see here. It says, on partnering accounts, how do you handle shortfalls if one partner's account can't cover but someone else's can? And would that change the share of contribution? Great question. So the first part of that is it depends on who your partner is. So let's use 2 examples. If I partner with the individual that asked that question, we're unrelated, non-disqualified. So let's just say we each put 50 grand in on a $100,000 investment, 50-50. Because we're unrelated, we could change the ownership over time. So let's assume that the person that asked the question, and that is Kimberly. Kimberly asked the question, right? So I decided I'm going to partner. My IRA and Kimberly's IRA go and we buy an investment together. If my IRA falls short, maybe there's a $10,000 assessment, right? I don't have the money. Kimberly could step in and say, hey, Jason, I will pay, right, your $5,000, but since you don't have the money to repay me, we will then change the ownership, or I will buy 5% of your 50%. So I'll own 45, and Kimberly will now own 55. We can make those decisions as we see fit. I could do it as a loan. There's lots of ways to structure it. Because Kimberly and I are unrelated. So as long as it's a fair market transaction, right, whereby the terms are moderately fair in the eyes of anyone that may look at it, we can make those decisions, right? If Kimberly was my spouse, because spouses are disqualified, I don't have that same option. If I buy it 50-50 with my spouse and one of us runs out of money, we can't give the other the money because that goes from a buying an asset side by side to actually trading money between the accounts, which goes from permissible to prohibited. So what most of our customers would do in a situation like that is a few things. Number one, they would make their annual contribution. So if I was $5,000 short and I was eligible to contribute, I would go to my own bank account and add $5,000 as an IRA contribution. If that doesn't work, then I may need to go find some other partner that can come in and either sell them a portion, sell them the entire portion. Maybe we agree to put the whole property for sale. But this is something you want to be very, very careful, because as I illustrated, when partnering with a non-disqualified party, I can solve these problems easily. When partnering with someone that's disqualified, we're writing that permanent marker, and my options are limited. So if it were me and I was partnering with Kimberly, my non-spouse, non-related party, I may get more aggressive and invest the entire balance of my account. If I were partnering with Kimberly, my spouse, then you better believe I'd probably want to make sure I got a pretty good cushion of cash to ensure that neither of us end up in a deficiency. So great question. And then it says, who puts together the partner accounts? Can NuView help with that, or do we have to have an attorney draft the documents? So NuView does not draft any documents. We provide some authorization forms that are ours for you to complete, but as far as legal paperwork agreements, we don't draft any of that. The beauty is, in most items like notes and real estate, you don't need a separate document. It's just on the title or it's on the note. Now, as far as a note and mortgage go, you would need to have an attorney create that no matter what, whether you did the whole deal yourself or whether you partnered. So when it comes to legal docs, we do not create that. As far as matching people up, we do not do that either. We do host, and obviously COVID, withstanding, we do host educational events and live events and quarterly events and a big annual symposium. And we do have a lot of clients that network at those events and do partner off on deals. But they make that decision there. We don't match make for anyone as a company. It says, how much do we have to have in an account if we want to eventually partner? There's no minimum. So if you want to start an account with $1,000, you just have to be prepared to put that money to work. So if we have clients that have started accounts with $50, right? Now keep in mind, the low, from a fee standpoint, you're going to pay more than $50 a year. So you have to be prepared for that. But if you're going to take that $50 and put it on an option that you think you can make 8 or 10 grand on, well, then it makes sense. So there's no right answer. Typically, what I see, and I'm only saying this typically, where people are the most comfortable is usually around $3,000 to $5,000. We do have clients that start with smaller balances, without a doubt. But generally, it's that $3,000 to $5,000 is the starting range. It's when the fees start to make sense, and it's when the opportunities get a little bit broader. If you're going to do less than that, that's great. You're going to pay a little bit more as a percentage in fees, but you're going to have, the ability to go self-directed. If we purchase an investment property through an IRA, can we purchase the property personally back from the IRA at profit to the IRA at a future date? So I think what you're asking, and it appears is probably a follow-on question to the property use. So what you're asking is, I'm assuming, and I'll use this because it's a very real-world scenario that we have lots of clients that do. You want to buy a property, let's call it a beach condo, that you really want to have at some point, but the money is in your IRA today. And so there are some ways to solve that. So if you wanted to use your IRA money to make an investment today that you believed may be a property you want to own later personally because you want to start using it once you own it, you can't buy it or sell it from the IRA. But you could, the IRA could buy it, so let's call it a $200,000 beach condo, which would be fantastically cheap, right? But you buy the beach condo, the IRA owns it. Let's assume you rent it for the next 5 years while you're wrapping up ahead of retirement. Rent goes into the IRA, expenses, it's all owned by the IRA, all filters in and out. 5 years later, you retire and say, you know what, it's time to be able to use this beach condo. I no longer want it in my IRA. You cannot buy it at that point, but you could withdraw it as a distribution. So you could take that property at the fair market rate today, so if you'd have to have it appraised, so maybe it's not 200, it's now 300. You can withdraw it. You don't have to pay for it, but what you have to pay for, if it's a pre-tax IRA, is the tax on that $300,000. Or if you believe it's going to grow and it's in a pre-tax account today, you could actually convert the $200,000 of cash to a Roth IRA, pay tax today on $200,000, and then buy that condo, treat it as a rental, and then when you choose to go live in it, withdraw it, but because it's in a Roth, it's 100% tax-free. So give us a call if that's really if I hit what you're looking for. We get this all the time, and it's a great strategy. I have a lot of clients that deploy it. It's a great investment today, and then they've got something they've locked up for tomorrow. If that's what you're looking to do, certainly give our team a call, and we can kind of walk you through that. There's a lot of opportunity there. What are the fees? So the way our fees work is if you open up an HSA or an ESA under $15,000, it's only $99 a year. HSAs and ESAs, right? And we do that because the contribution limits to those are much smaller and they're hard to build up. So it's $99 a year, right? If you open up any kind of IRA with us, the annual fee basically up to $15,000 is $195 a year. right? So whether you have $1,000 or $14,000, it's the same $195 fee. We have a transactional fee of $95 to buy or sell investments, but that's only charged when you physically make a purchase or make a sale. You can take a look on our website under individual investors. Our fee schedule is there for the details. But fees are cheap, very, very cheap. They may sound like a lot in real dollars or as a percentage, but they're very cheap. Because what you have to keep in mind is whatever you make, whatever investments you participate in, is all yours to keep. Whereas when you invest in mutual funds and other things, you don't keep all your earnings. There's lots of fees inside there that are yanked out, right? And then you get what's left. The beauty of a self-directed IRA is you pay me the $200 a year and the $95 transaction fee, and you can make $1 billion and there's no additional fees. Whereas if you bought a mutual fund that went up by $1 billion, there'd be thousands upon thousands of dollars of fees raked out of that before you saw your income. So these are very cheap as a process, and what you see is what you pay, right? All right, let's see. Someone said, this is eye-opening. I'm going to start right now. Awesome. We love that, and it's something that I think everybody should strongly consider. In fact, this slide really talks about how to do that, and that is the first step in this is talk to our team. Kind of tell us what you're looking to do. We're not advisors, but we've seen a lot. Let us help you get your account set up. You can't start self-directing until you don't have it. And if you don't start it because you're just going to wait till you have the money to save, you'll never do it, right? We encourage clients, start the account, put in a little money today, add to it every week, every time you get paid, because it's the only way to really build up money, right? If you wait until the end of the year and I'll just put in the $5,000 then, you'll never put it in. It's the reason why 401k plans have significantly more money than IRAs, because nobody contributes to IRAs once a year. Very few people do, because by the time the year rolls around, you go, oh, do I want to put in $4 grand? I'll just put in 2 because I want to go buy something over here. When you take it out of your paycheck every week at a couple $100, you put in $5,000, $6,000, $7,000, $10,000, and you don't even notice it. You can do that yourself in an IRA right through your bill pay system at your bank, and just put in NuView, tell them you want to put $50 a week in, and it'll just send a deposit into your account every single week. So I would encourage you to do that. If you do want, you can text us. I'll ask you a couple questions. If you want our e-guide, you can text now to 33339. But that's a great guide for those of you that may want a little bit more reading. You can also go to our website, and the e-guide will pop up. You can plug your information in and get the download there as well. But this just shortcuts that process for you. So I will take the last few questions. We're a tad bit over the 1 o'clock, so let me see if anything else has come in. If you've got them, now's the time to ask them. Before we wrap up here, let's see. I don't see anything new in the chat. I don't see anything there in the Q&A. Going once, going twice. Awesome. Well, thank you guys very much for joining us today. We continue to put content out. You can see pre-recorded stuff that we've done in the past on the blog section of NuViewTrust.com, or make sure that you're getting our emails. We give you a full list. Obviously, with COVID, we've increased our amount of educational content that we're putting out through the web, so we certainly encourage you to join as many of these classes as you want. There's no charge. We want to make you smart. More importantly, we want to make you a client. So we look forward to hopefully having your business here in the short-term future, and we encourage you to give our team a call. But thank you, everybody, so much for joining us. We'll look forward to chatting later.